How do you navigate a market sell-off? Eric Lynch of Scharf Investments has a few tips.
First, let's look at what happened to date. We've had a risk-on market for years, growth, momentum, U.S. tech, U.S. exceptionalism, and now that prevailing trade has been flipped on its head. So it's gone from risk-on to risk-off. That's what investors need to focus on. There's a lot of undervalued opportunities out there. You're seeing leadership across the market in non-U.S. stocks, particularly in Europe, where Germany and France are going to have to rearm. You're seeing other opportunities in small cap, but where you're really seeing opportunities within the United States is you're actually still seeing really big time market outperformance from value stocks, and kind of low volatility stocks. That's a way you can still play this game. You can also play it in credit, fixed income, after years of declines is getting a bid here. Also continued kind of currency hedges like gold. Those are all opportunities that have been kind of leading the market year to date after kind of underperforming, generally speaking, for years, Lisa.
Any individual stock names that jump out at you?
Yeah, just to kind of highlight that difference in kind of defensiveness versus risk. Max 7 names year to date through yesterday are down 15%. Tesla down 40%. Tried and true. We all thought he lost his touch until recently. Berkshire Hathaway, Warren Buffett, up 9%. So defensive versus risky, you're still seeing a lot of opportunities there in the defensive that have lagged for a long time.
The Dow today is leading declines, likely due to President Trump threatening to double the tariffs on Canadian steel and aluminum imports to 50%. What do you make of this latest trade salvo?
This is the big problem. Canada supplies about 24% of U.S. steel and over 60% of U.S. aluminum. So in the words of the Ford CEO, who probably says it and knows it best, this will blow a hole in their business. So this is not good for industrials, automakers in particular. That's probably why the S&P 500 on a sector basis is being led on the decline by industrials today.
Just a couple of months ago, Eric, we were talking about the Fed orchestrating a soft landing. We were talking about a strong economy. Now we are looking at a stock market that has erased all gains since the November election, and we're talking about a possible recession. How surprised are you about that?
I think what's surprising, Lisa, is the sequence of events here. The Trump administration has some big goals. They probably should have started with the short-term gains, which would have been, in our opinion, an extension of the tax cuts in 17, and also, some lighter regulatory touch. Instead, they've gone after the long-term structural goals first, which are kind of rebalancing U.S. trade and also trying to get more private dollars into the economy versus government spending. That is very difficult to do. It's going to take a long time. And so that lack of certainty in the market is really kind of paralyzing consumers and businesses.
Today's JOLTS report showed that job openings in January were higher than expected. But what does this tell us about how companies may respond to Trump's tariffs going forward?
Well, that's a good question, Lisa. The good news is that we have to remember that the service economy still represents about 75% of US GDP. And so service positions, service openings are still strong. JOLTS, the job opening number for January increased month over month to 7.75 million. That's a good sign. I'll just reference Powell's comments from Friday. Despite the level of heightened uncertainty, the economy is still in a good place. And that's something we need to remember across this market volatility.